Today, we are breaking down an absolute masterclass that explores the two fundamentally different games being played every single second in the financial markets. On one side, you've got the fast-paced, high-stakes world of trading, and on the other, the methodical, marathon realm of investing. If you've ever wondered why some people absolutely thrive in market chaos while others build massive wealth by, well, simply sitting on their hands, you are in exactly the right place. Let's get started. So here's our roadmap for today. We're going to break down the psychological traits of traders versus investors, tackle the big active versus passive investing debate, figure out how to master risk management, face a quick tax reality check, and finally, bring it all together to build your winning market strategy. All right, let's start right at the foundation, the battleground of the mind. This is where the adrenaline-fueled sprint of a trader meets the marathon mindset of an investor. It is fascinating to see how perfectly these two cognitive loads contrast. I mean, think about it. Traders are completely wired for speed. They thrive on rapid-fire decisions and constant stimulation. And their success actually depends on ruthless emotional detachment. They have to cut their losses instantly. But then, on the flip side, look at the investor. Their whole process is slow, analytical, and incredibly deliberate. They need the discipline to block out all that loud market noise and just hold. Basically, one brain is sprinting while the other is pacing itself for a multi-decade run. But here's the massive plot twist. Both of these avatars fall prey to the exact same cognitive traps. It doesn't matter if you're day trading, futures, or holding blue chip stocks for your retirement, your brain naturally wants to seek out information that just confirms what you already believe, right? That's confirmation bias. It makes you overconfident after a few winning trades, and it tricks you into valuing today's news over a 10-year trend. So the reality is, whether you're trading or investing, managing your own mind and keeping that emotional discipline in check, that is your true edge. Shifting gears over to the investor's playbook, we really need to tackle one of the most massive, ongoing debates in wealth building, actively picking stocks versus passively tracking the market index. It all boils down to one simple question. Can professionals consistently beat the market? You probably assume that highly paid mutual fund managers with their massive research teams, advanced algorithms, and direct market access can easily outperform a simple, boring benchmark index. I mean, they're the experts, right? It just makes sense. Well, the data is actually absolutely brutal. According to the SPIVA scorecard, which measures S&P indices against active funds, a staggering 81.5% of actively managed large-cap funds in India failed to beat their benchmark. Just let that sink in for a second. More than 8 out of 10 professional, full-time fund managers couldn't beat a simple index over a one-year period. And wait, it gets worse, because time actually works against active managers. Over a 10-year period, those failure rates climb to roughly 85% in large-cap markets globally. Why does this happen? Well, large-cap stocks are heavily researched, which makes finding a mispriced stock incredibly difficult. And what's even crazier is survivorship bias. Roughly 30% of underperforming funds simply disappear. They merge or liquidate over a decade. So a lot of the success data we look at is artificially propped up by just the survivors. The real secret behind why those active funds struggle so much comes down to the expense ratio gap. Paying a 1.5% management fee for an active fund might sound tiny when you're signing the paperwork, but watch what happens when that compounds over 20 years on a 50 lakh portfolio. It ends up costing you a massive 73 lakh in lost potential returns, compared to a simple, low-cost index fund charging just 0.2%. You are essentially paying an absolute fortune for a significantly lower probability of success. It's wild. Okay, let's accelerate our pace a bit and step out of the quiet investor's lounge and right into the trader's room. In this world, your survival entirely depends on ruthless, calculated risk management. Intraday trading is an incredibly fast, totally zero-sum game of survival. It's this intense, highly competitive environment where, honestly, 70 to 90% of retail traders are completely unprofitable. And the reason why is pretty simple. They focus entirely on their entry signals and totally ignore building a multi-dimensional risk framework. If you want to survive the inevitable losing streaks without completely wiping out your account, you have to be like the elite traders. They pre-commit to strict mathematical guardrails. Take the 1% rule. If you have 10 grand in your account, you literally never risk more than $100 on a single trade. And then there's the 3% rule, which acts as your daily circuit breaker. If you hit a 3% loss for the day, you're done. You step away from the screens. This automatically prevents that dangerous cognitive bias of emotional revenge trading from completely draining your capital in a single afternoon. Let's look at the actual math that builds this edge, because this is where it gets really cool. If you structure your trades with a 1 to 2 risk-reward ratio, meaning say you risk $1 it on the instrument's daily volatility using the average true range. You might place it just beyond a technical support level, or you could simply use a time-based stop to make sure you aren't holding risky positions overnight. The main takeaway? Entering the market without an automated stop loss is just letting your cognitive biases convert totally manageable, normal losses into catastrophic ones. Let's take a quick breath, because whether you are rapidly day trading futures or holding index funds for decades, you absolutely cannot ignore the silent profit killer. Yep, we're talking about taxes. This is a pretty harsh reality check for a lot of people. If you're day trading, swing trading, and you're holding assets for less than a year, all those profits are categorized as short-term capital gains. They get taxed as ordinary income, which can climb up to a staggering 37% for top earners, plus potential extra investment taxes. Now, compare that to long-term gains for holding an asset for over a year. Rates drop to 0, 15, or a max of 20%. The whole tax system is designed to heavily penalize high-frequency speed, while heavily rewarding the patience of position traders and long-term investors. So if you're going to trade actively, you have to actively defend your capital. This is exactly where tax loss harvesting comes into play. The strategy here is to spot your underperforming assets and intentionally sell them at a loss to offset those super expensive short-term capital gains. But carefully, you must avoid the IRS 30-day wash sale. You have to wait at least 30 days before repurchasing that exact same asset, where your deduction is entirely disallowed. Honestly, an even better approach is to try and do your frequent trading in tax-sheltered accounts like IRAs to protect those gains. Alright, we've covered a lot of ground. So with all this data on mindset, risk, and taxes, how do we actually synthesize the speed of a trader with the patience of an investor into one unified, practical playbook? Enter the core satellite strategy. I love this because it is just brilliant. Here's how it works. You allocate the bulk of your wealth, say 60 to 70% of it, into the core. These are your low-cost, large-cap index funds. You capture those guaranteed market returns for